So all of us are aware that in February, Nigeria's National Bureau of Statistics released a report wherein it detailed its rebasing of the Nigeria's Consumer Price Index. Uh, of note is the fact that this event is supposed to be usually based on economic best practices. It's meant to be a 5 year event, but because of reasons beyond their control, they hadn't done it for like 15 years. The last time it was done in Nigeria was in 2009. But in 2024 or 2025, they released the new figures for this rebasing, which was a 15-year lag between 2009 and the current period. And basically, what we saw from the result of the rebasing exercise was that our inflation figures as at January 2025 declined or printed at 24.48% compared to the previous inflation figures as at December, which was 34.8%. This has raised a lot of issues, a lot of discussion and commentary in the Nigerian public regarding what has happened. A lot of comments from analysts and ordinary citizens uh, have been generated asking what these figures mean for the Nigerian economy, for the Nigerian people, and all that. So, in this webinar, we'll try and provide some level of context to what these figures really imply without trying to bore you with a lot of terminology and jargons. Basically, what these figures indicate are as follows. But before we launch into exactly the nitty-gritty of the rebasing figures, we would like to provide some level of context into what CPI exactly is all about. CPI is something that has been bandied around in the public space in the couple of months since the rebasing exercise was done. But what exactly does this mean? Basically, CPI is just a measure of the average change of goods and services in an economy. So what it tries to do is it looks at the basket of goods, and what that means is that it aggregates the number of goods that are usually or normally consumed by people in that economy, and it tries to like see how those goods, the prices of those goods changes from period to period. So it could be on an annual basis or on a monthly basis. So that is basically what CPI does. It generates a composite figure, which is called an index, to capture the changes in those particular goods. So, and it does this by setting the particular base year. So the base year is the year from like ground zero, where all prices are aggregated to 100%. So subsequent changes in the inflation in the prices of those goods are marked from that particular base year that has been set, and changes are now calculated in percentages to arrive at your inflation rate. So but for you to use that particular basket of goods, there are factors that have to be considered, and the factors include the fact that it must be a representative collection of goods. That means that these are goods that the people in this economy normally consume. That was why, if you look at it critically, it was important for the Nigerian National Bureau of Statistics to rebase the CPI, because the period of time that had elapsed 2020 and 2025 to 2009 was 15 years, and that was a long time in which a number of changes had happened in the Nigerian economy in terms of the patterns of consumption. So in 2023, when the National Bureau of Statistics conducted a national living standard survey, they discovered that some hitherto uncaptured sectors, that the 2009 base year for inflation or CPI did not account for or did not give enough priority to, had now become more prominent in the basket of inflation. So they decided, okay, it was now important to include these particular items in the basket, because going forward without doing this would mean that Nigerians' consumption patterns were not really being properly recognized in terms of how they consumed goods and services. So, what is CPI rebasing? Basically, it looks at three major things. One is that it tries to look at the composition of the basket, and in the course of this particular analysis, the rebasing, this National Bureau of Statistics was able to increase the number of items in the basket that Nigerians consume. So, from about 740 items pre-rebasing, it moved it to 934 items. Equally to, it changed the weights of some of the items in the basket to reflect how Nigerians consumed these particular commodities. Going forward, we'll see how these changes have been effected in the commodities in question. Then equally to, it changed the base period. Going forward, will be able to show you exactly what has changed. So in essence, while the inflation figure seems to have dropped, where it is of note that it is not doesn't mean that prices in the market have changed per se. What it's trying to tell us is that the way we measure our consumption of this particular product has changed. So let us be wary of these changes, this distinction. So this provides us with a context in terms of timeline for what has happened. The last rebasing exercise, like I mentioned, was in 2009, 15 years before the current update. By best practices, as recommended by ILO and IMF, it is expected that on a periodic basis, usually 5 years, 5 to 10 years, economies should rebase their CPI to ensure that they capture changes that have occurred in their consumption patterns. But as we saw in our own case, for the last 15 years, we hadn't done that. So that had led to some distortions in the inflation basket. So some products that had gained prominence were not included. Things around digital consumption, the way people stream music, movies, and all that. These things had changed and evolved over time the last 15 years, but because the inflation basket had not been updated to capture them, it was giving us a misleading picture of how our consumption patterns were. Equally, too, we saw that one key feature of the rebasing exercise was that the start of date was January 2025, and the data source that the whole exercise was based on was the 2023 National Living Standard Survey. So this was the source of the data that led them to increase the number of items in the basket and all that. Going forward, we'll also break down this particular rebasing exercise to show us some the key changes that have happened and how they have impacted the number of the inflation rates that has come out at the end of the whole process. So, among other things, we've seen a classification structure change. So the previous change or classification structure was as at 1999. The version that was being used prior to this current rebasing exercise was at 1999. But during the rebasing, they moved it forward to 2018 version. What does this mean for us? It just shows that it's a bit more modernized. It's more up to date than the previous one. The number of divisions under this classification structure has also increased by one from the initial 12 to 13 now. And it helps us to get a better picture of the sectoral consumption patterns. The number of products too has moved from 746 to 934. It shows that there's a bit more comprehensive coverage of all the commodities that Nigerians consume on an average basis. The weight of food in the consumption basket has also been slightly adjusted from the initial 51.8% to 40.1%. As we go along, we'll see what happened, what led to this reduction. It does not necessarily mean that Nigerians consume less food now, but there has been a subtle reclassification among divisions that has led to the reduction in the weight of the food basket. Equally too, there has been a slight change in the expenditure or the way the expenditure is calculated for certain categories. So at the end of the whole process, what was the outcome of this particular rebasing exercise? We noticed that there was a new print of inflation or a new reading, which was 24.48% as at January 2025. The previous one was 34.48, and that was as at December. That was as at December, now compared to the 24.48 as at January. So what does this imply? Most people are wondering, okay, does it mean that, oh, now prices of food and other items in the economy has increased, has reduced or has gotten better? But that is going to be like looking at it from a confusing perspective, because there are two different series that have led to this outcome that we are seeing currently. Food inflation too has seen in terms of the outcome, we've seen a 26.08% outcome for January 2025 inflation figures compared to the 39.8% as at December, while core inflation, which is the one that measures aspects of inflation that are a bit more stable, that do not fluctuate or are not as volatile as other items, has also shown a different figure, which is slightly less than the previous month's figure, which is at 22.59%. The urban-rural gap too has also shows some interesting dynamics. We've seen that the rural inflation figures is slightly less than the urban figures. So at the end of the day, like I mentioned, it's not like the prices of commodities and all that in the market has dropped or anything. The lived reality of Nigerians is that what was obtainable a day before the rebasing exercise was concluded and the new figures were published still remains more or less the same. Prices of commodities in the market have not really changed. If anything, perhaps they're even increasing. But one thing that should give us a guidance in terms of how much inflationary pressure still exists in the market is the fact that the month-on-month change in inflation, as at these new figures that were published, is 10.68% compared to 2.44% in January. If anything else, that shows you that the inflationary pressures in Nigerian economy has still reasonably intact. So it gives us some level of a sense of the fact that prices in the market have not changed. So we should not conflate the fact that the CPI rebasing has resulted in a lower headline inflation compared to the previous month's figure. So I'm trying to explain what the paradox of this figure distinction between the December figure and the current rates are. This just presents us with what the changes have happened that have happened. So we've seen a 10.32 percentage point in decrease or decline in the headline inflation rate from 34.8% to 24.48%. But what is the economic reality around this figure? Prices remain high and there's minimal relief for Nigerians in terms of their consumption and purchasing power. Same for food inflation. We've seen a decline in terms of the percentage points headline rate for the food inflation by 13.7 percentage points. But in terms of food costs in the market, nothing much has changed. Same for core inflation and all that. Like I mentioned, the major figure that has shown us that inflationary pressures have remained unabated is the fact that our month-on-month figures have shown that inflation rate is still a bit high, which is at 10 point something percent, over 10% compared to the 2.44% as at December. Nigeria is not the only country that has rebased or is rebasing. It's advisable for country to rebase because of the fact that consumption patterns change from time to time. So if you leave it for too long, you'll be missing out on capturing some commodities that have now come up in the consumption basket to be major commodities that your nation consumes. So just looking through some of the countries in Africa that have done this rebasing exercise in recent times, we looked at some of them such as South Africa, Kenya, Ghana. And from all indications, we see that because of the fact that their own rebasing cycles were a bit more in line with best practices, their figures after the rebasing exercise was not so much different, wasn't large. So, for instance, South Africa as rebasing figure ended up by just 0.2 percentage points increase. Initially, it was 5.7% when they were doing the rebasing, but after the rebasing exercise, it ended up at 5.9%. That was in year 2022. Same for Kenya too. The exercise led to a negative 1.5 percentage points decline in the headline inflation rate. That was as at 2020. And for Ghana, when they did theirs in 2019, they saw a 1.6 percentage point decline in their inflation rate. What does this show us? The magnitude of our own was because it was a bit delayed. We had not done it for 15 years, 3 times as much as the expected or the advised period of time that we should be doing this exercise, 3 times 5, 15. So equally to the direction and variability, we'll see that most countries that have done this particular exercise, most of them had their inflation decline in the immediate aftermath of this rebasing exercise, except for South Africa that saw a slight increase of 0.2 percentage points. Equally too, we saw that most countries that have done this particular exercise, they implemented gradual basket update. So South Africa, they do it right every 5 years, and because of that, we've seen the figure that came out of their exercise was not as prominent as in other countries. Again, too, typically after most rebasing exercises, though the inflation seems to decline, but after a period of time, structural realities set in again, and we see that inflation begins to sort of pick up again over time. So, in essence, what this is just saying is that following through on the best practices as advised by the IMF and ILO, International Labour Organization, will help to minimize some of all these discontinuities and huge volatilities and other issues that we've seen that has applied to the Nigerian case because of the long period of time that it has taken them to do this exercise. So, at the end of the day, what does this figure that has come out of the inflation exercise or the CPI basing, what does it mean? What does it imply for us? Obviously, from every exercise, there will be seemingly gainers and losers from this exercise. For Nigerians, who are the winners and who are the seemingly losers in this particular exercise? So on the winning side, we've seen our government being a beneficiary. And why is this the case? This is the case because right now the CBN seems on surface value to have been able to reach a positive real interest rate in terms of the monetary policy rate. As at their last meeting, it was 27.5%, which they held. They didn't make any changes to it in the wake of this particular rebasing exercise. But compared to the inflation figures that were published, the difference is now a positive. So it seems as though our real returns now are positive. So for governments, it has helped to ensure that it has painted a picture of achievement of policy goals of making real returns positive. For bond use issuers too, it leads to a potentially lower inflation premium. While for fixed income earners, it gives us, like I mentioned, on the side of the government or the CBN, it gives the appearance of higher real wages because now it seems as though you are net positive in terms of your real return vis-a-vis inflation. In terms of international image, it helps you to come back into the league of countries who are on a better ranking in terms of their inflation numbers. On the flip side, we've seen losers too for of this exercise. And who are the losers basically? So wage earners. And what does this mean? In real terms, because nothing has really changed in terms of the lived experience of Nigerians, in terms of how their incomes and all that, it has still led to is still the pressure on terms of their incomes remains the same. Official figures will make it look as though their cost of living has improved because inflation figures headline seems to have come down lower. So the momentum to go into wage negotiations from the side of government may appear to be a bit diminished. So for wage earners, that is a loss. In terms of contract holders with inflation escalation clauses, that is also a problem because right now, for those that have those kind of contracts in their agreements, it becomes like an issue for them. They are how the opposing parties will be like, oh, okay, now that inflation has come down, so you need to like sort of decrease your cost of this particular service. In terms of that data continuity too, making comparisons with previous inflation numbers becomes a bit tough because there's a discontinuity. There are two different series right now being considered. So it's not a straight line view of looking at current inflation figures and what the previous figures were. It will lead to a lot of mismatch and a lot of discontinuities and confusion and then lack of clarity. Equally to policy transparency too is an issue. It could lead to possibility of misinterpreting economic trends and risk of inappropriate policy responses. So at the end of the day, in the light of all these developments that we've seen and highlighted, how should we respond in terms of our uh, our businesses and all that? So for businesses and other economic agents, but for businesses in particular, they should have some of these particular suggestions at the back of their mind. In terms of their strategy, consider a number of strategies such as differential pricing, because prices have not really of their own inputs into their production has not really changed. So they can't just say that okay, because the headline inflation figure seems a bit lower, they should now go back and reduce prices. So, but because there are some sensitive customers who will push for such changes, then they should have some level of differential pricing such that they cater to such sensitive consumers while still maintaining margins with optimized volumes. Equally to product reformulation is a particular method they could use. So we've seen issues around shrinkflation, which is gradual reduction in the size of goods that are being sold. So for instance, a sachet of say Milo gradually getting smaller but remaining at the same price. So this is also a method that a number of businesses can adapt to ensure that they're able to cope with the current climate of seemingly lower inflation rates. Meanwhile, the lived reality appears to be different. So equally to ensure that they're able to manage costs, supply chain localization is a key issue. The better they're able to sort of reduce their dependence on foreign supply chains, which is prone to FX issues, which is also a factor into imported inflation, the better it is for their businesses. In terms of productivity investments, this is very critical. Technology is making productivity is enhancing productivity lately. So investment in productivity is in technology is a very critical factor right now in terms of making sure that they're able to manage costs. Forward contracts too. The ability to lock in costs by having forward contracts with suppliers is also helping too. It will also help for businesses to ensure that they're able to manage future costs. Okay, so for households, how can they cope? Obviously, because nothing has changed in terms of real prices, they have to ensure that their budget reallocation is aimed at ensuring that only essential items are prioritized. Equally to where there is a possibility to shift to lower cost alternatives by substituting from one particular form of product to the other, that is something that should be encouraged. Group purchasing, where people buy in terms of in bulk, is also a method to help consumers to ensure that they're able to manage costs better. Savings protection is very critical at this point in time. So investments and ensuring that you put your funds in assets that are inflation resistant is a critical factor. Skills development is also critical to ensure that you're able to diversify your streams of income. For investors, a number of portfolio adjustments are recommended. And what are these portfolio adjustments? Focus on real returns. So target investments that are exceeding rebased CPI. So treasury bills and the like that show some level of over that are at a level above the current rebased inflation figures are best chosen. Asset class shifting. Increase your allocation to inflation resistant assets. This will obviously at the end of the day help to protect your portfolio. Time reduction. So shorter term duration income instruments are preferable at this current point in time because of issues around uncertainty in terms of how the inflation figures will play out over time. There are so many factors that will still have some level of impact on the trajectory of the inflation numbers over the period going to the future. So shorter duration fixed income instruments are better. Lock in right now. Sector rotation. So focus on companies with pricing power and diversification too. So geographic and currency exposure beyond Nigeria. So at this point, to just recap, the whole exercise was done by the Nigerian National Bureau of Statistics in line with best practices, and it has come up with a particular data point which is going to guide all decisions in the economy going forward, both by government, by businesses, by individuals. But knowing fully well that in reality things have not changed in terms of the purchasing power of Nigerians, it behoves on us as Nigerians and other businesses and other economic agents within the economy to try and put in place all these measures to try and protect ourselves from any adverse realities that could ensue. Like they say, there's this particular picture that is always being painted when there's an amputation happens. Over time, the people whose limbs or their limbs are amputated, they still have some phantom pain. They call it phantom pain, even though the limbs are no longer present anymore, but they feel some level of pain in those missing limbs. So the same thing sort of applicable to this current situation. While this exercise has sort of amputated the inflation rate, made it a little bit lower, but Nigerians are still feeling the pain in their pockets. So on because of all these, Nigerians should try and implement some of all these particular suggestions to make things a bit easier for uh, their pockets and their lived experience. Thank you. At this point, we'll take your questions and comments. Thank you.
Thank you very much, Jide, for the insightful presentation on Nigeria's base CPI. So we have received one question. I'll just very quickly take that from Fadekemi Abiru. Please give me a minute. Okay, so Fadekemi says, given the January 2025 numbers are under the new series and December 2024 numbers are under the old series, isn't it wrong to compare the two present the January 2025 as a full compared to December 2024? She says basically they're apples and oranges. We should have the backcasted series so we can properly gauge the true trajectory of inflation in Nigeria?
Thank you, Fadike, for that lovely question. Best practices always suggest that once these sort of exercises are always concluded by the National Bureau of Statistics of a particular country or the statistics office in those countries, they should have those inflation prints, run parallel for a point for some point of time, equally to take it backward so that you can be able to show some level of comparison. So obviously, like we mentioned in the course of this presentation, looking at just one point in the print, the January print under the new series versus the old print series, which ended as at December, is going to lead to a lot of discontinuities and misinterpretation. So just like you mentioned, the ideal thing based on best practices is to have the statistics office sort of take it back to show how the series has moved. The new series will have evolved over time so that discerning investors and other users of that information can also look at it and show and make reasonable deductions from all those from the two numbers and all that. So basically, in agreement with you, yes, that is the ideal thing. It's not impossible that as we go along, we'll see the National Bureau of Statistics release the backcasted figures to give Nigerians a better picture into what has happened in terms of the old series, the new series, and all that. Thank you.
Thank you. Thank you, Jude. Fadikemi, I hope that answers your question. We have more questions. This one is from Opeyemi Ashaolu. Thank you for the insightful discussion, Opeyemi says, prior to the rebasing of the CPI, one could say that there was a strong positive correlation between Naira depreciation and the inflation rate, like we saw in the first half of the previous year. Do you think the additions to the inflation basket and the reweighting of items such as food might help to reduce the susceptibility of prices to currency depreciation?
Yeah, thank you, Opeyemi, for that insightful question. In answering this question, I'll be very careful in basing the trajectory of the naira on just one single data point, which is the inflation numbers. And that is because there are so many factors that influence the trajectory of the naira beyond just what happens to inflation figures and all that. A number of them are beyond Nigeria's immediate control, such as things around what is happening in the global environment. As you will agree with me, a lot of the strength that we've seen in the naira has come from a bit of interventions in the market by the central bank and all that. So that goes beyond just inflation numbers and all that. So how will the CBN will be able to maintain the firepower to sustain these interventions, among other things, is a different conversation. So if you want to answer that question without looking at all these other extraneous factors, all these other exogenous factors, and you just place it strictly on the inflation angle, then you may be leading to misleading results. Yes, for now, inflation seems to be relatively looking better. And like you said, a bit of it has moved in terms of it may help, because the basket has been diluted among other things. They've moved some items around. They've moved, for instance, in the food basket, they've moved. Part of it has been reduced to 40%. It has been reduced to 40% from the initial 51%, and that has been because of the movement of the meals away from home from that category or from that division to another category, which is the restaurant category. So all these things, yes, at the end of the day, they've helped to some extent put inflation on a downward trajectory compared to the previous CPI series, which was as at December, which ended as at December. But in terms of how it will feed into the naira strength going forward, remains to be seen. One thing I would say is this: it's very important that all decisions that the CBN makes with respect to the policy rate remain very guarded and very prudent, because that is where they could get it easily wrong. If they feel that, okay, because as at this point in time, the real returns are now positive because the policy rate is 27.5 and inflation rate is 24.48. So they have some leeway and flexibility to, you know, tamper with the interest rate and become a bit more accommodative. If that happens, then it could lead to that unfavorable movement in exchange rates. So basically, that is the answer in summary. Let's not focus strictly on the inflation aspect. That is there, no doubt, but beyond inflation, there are other factors that could have some level of impact on the exchange rate. So we should not also lose sight of that. Thank
Thank you, Jide. We have another question from an anonymous attendee. This person says, you said the reason for the rebasing was on the back of a new consumption survey conducted in 2023. Can you shed more light on that?
Okay, thank you so much. So the National Living Survey was conducted by the National Bureau of Statistics in 2023. It's something that they do periodically, and it was done in 2023. And from the figures that they got, they felt okay. Some of the items that were not captured in the 2009 baskets that had been used for inflation and CPI calculation have now gained some level of prominence. So, for instance, if you look at the new division, they add in terms of the classification, they added a new division. That was the digital, the financial aspect, and that was because they felt okay, things had evolved. So, for instance, in 2009, uh, things around say Netflix, streaming, data, and all that, Spotify, which is now commonplace, they were not big issues as at 2009. But based on that survey they did in 2023, they saw that okay, other commodities that they had not given priority to, that they felt were not adding much to the consumption of households in Nigeria, have now gained some level of prominence. So they decided, okay, in conducting this CBI rebase in 2025, that was the anchor, that was what they based their weighting of the categories on. So they felt, okay, now that digital and financial services have gained some level of weight and all that, they should sort of make sure that these things are reflected equally to health and education. We are also giving some level of priority to that made them a bit higher. So that was the whole essence of it. It's something that is done typically by statistics offices across different countries to ensure that they are keeping close tabs on changes in the consumption patterns of the country where they are operating from. Thank you.
Thank you, Jide. Another question from Fadikemi Abiru. She says, what are your views on the weight adjustments that led to a reduction of food and non-alcoholic beverages component, while restaurants, I beg your pardon, and accommodation services were increased? Do you think that's representative of the average Nigerian, or does it risk skewing the numbers towards the urban population?
Okay, thank you for taking me. So, basically, the motivation or the interpretation you could adduce to that change or that shift in weight from the food baskets to the restaurants is, I think, this MBS is trying to recognize the fact that Nigerians have an appetite for dining out. That over time, yes, not that it was not there, restaurant was a category on its own which recognized that, but over time they felt that that had some gained some level of more prominence in terms of our consumption patterns, and they felt to recognize that they needed to move that some of the weight under food to the restaurant category to make it a bit more reflective of the patterns of consumption that they've observed in Nigerians' consumption habits. So that was what led to that particular movement. Obviously, yes, a movement of weight around have different levels of impact. So by the time you consider the fact that some level of volatility that you see in terms of food prices may not be as prominent in terms of restaurant dining. So what do I mean by this? If there's a increase in terms of prices generally, and restaurants want to probably make adjustments, it's not going to be as common or as obvious as pure food items. So what I mean is this: if you go to a restaurant and there's been a change in their inputs and they want to factor it into the ultimate price that you are paying as a consumer, they'll probably just have slightly reduce the portions that they are serving you. Meanwhile, you pay the same price. But for food items in the market, once it happens from the farmer side and it gets to the market, the traders are already telling you that, oh, sorry, tomatoes are right now at this level. So you feel the volatility in terms of prices more faster in the food basket than in any other part of the chain. So obviously, part of those movements, reducing the food basket by that amount, 11.8%, and transferring that virtually that same amount to the restaurant category has helped at the end of the day to reduce a little bit of volatility and by extension the overall inflation numbers that we've seen. So basically those were their thinking and that was why they did what they did. Yes, obviously you are correct in the fact that you do not see so much of those kind of things in the rural areas, but it's still a reality of Nigerians that there's some level of consumption of meals away from home that is going on in recent times, and they needed to capture that particular uh, pattern, consumption pattern in the new figures and all that. Thank you.
Thank you, Jide. I have a comment, not a question in this case, from Dapo Oshunkoya. Sorry. The absence of an inflation targeting stance by the CBN is quite of concern. The rebasing exercise is long overdue, in my opinion. However, an inflation target should be set to guide policymakers across all stakeholders. I'll be taking my next question from, okay, Chide wants to give a response on that.
Okay. Thank you so much, Datbo, for that observation, for that comment. But I do not think it's 100% correct that there's no inflation targeting by the government. The CBN stated categorically that they are looking at an inflation target of like 19.8 to 25 point something percent, or a middle ground of 21% thereabouts. So the current dispensation of the CBN under the new CBN governor, Cardoso, mentioned that specifically, and it's something that is published and we can easily reference. It's in one of their statistics documents. They are looking at an inflation target for 2025 in the region of 19 to 25%, or a middle ground of like 21%, or rounded up to 22%. So that appears to be an inflation target, which the CBN appears to be pursuing with some level of vigor. And I think that has influenced what we saw last year in 2024 of 875 basis point hikes over the course of their monetary policy meetings. So that has helped them to try and target that attainment of that particular inflation target. So just to try and put some perspective and context into that particular comment. Thank you.
All right. Thank you, Jide. My next question will be from Vera Osuji. She says, why is Nigeria's rebased numbers reflecting such a wide positive variance compared to other African countries? What factors do you think may have led to this difference?
Thank you so much, Vera. Very great question. And a number of factors have added up to arrive at this seeming variance that you've pointed out. So, among other things, in the course of doing this, like I mentioned, they moved away some aspect of the food volatility, food basket to the restaurant division. Like I mentioned, food is a bit volatile compared to restaurant dining and all that. Before restaurants will increase prices, there is a way they would quote unquote package it to make it look as though prices haven't changed, but obviously the portions have shrunk sort of. So that has also that particular movement is a contributory factor to the lower level of inflation that we've seen. Another thing that has happened is the fact that in the housing division, they've reduced the weight. And part of why they did that was that they felt that imputed rent is not going to be captured anymore. What does imputed rent mean? It means that owner occupier houses, they're not capturing or valuing the rent that they should have paid if they were paying rent on their property. So that is also a factor that has also contributed to the ultimate lowering of the Nigerian inflation rate that has come out of this rebasing exercise. Equally to they moved away student accommodation from that housing category too. So that's another factor. Beyond those slight movements here and there, shifting of weight, equally another factor that has helped in a sense is the changes in the methodology that they've adopted. So going to technical terms, there are some methods that they use in terms of capturing the weights and capturing the CPI. So like there's the Lowy, there's the Dutort, there's the Young methodology. So a couple of them that they've used prior to the previous ones have also helped to sort of make sure that the volatility that we've seen in the inflation numbers at the end of the day have been weeded out or have been sort of have been erased. So for instance, it's just like take an analogy right now. A particular method helps measures your weight, and while that method measures your weight while you are standing fully straight, the other one measures your weight while you are a bit slouched. Obviously, at the end of the day, these things would add up and result in a figure that is a bit slightly lower. So all these methods are based on proper theory and in the recommendation for best practices. It just depends on what each National Statistics Office decides to use. So in simple answer to your question, these are some of the areas where weights have been shaved off from the headline inflation number at the end of the day. Thank you.
Thank you, Jude. Our next question will be from Nonso Ndumaya. I hope I got that correctly. He says, how can subnational governments leverage the rebased consumer price index? I'm sorry, I'll take that again. How can subnational governments leverage the rebased consumer price index data to improve fiscal planning, especially in areas such as social interventions?
Thank you so much, Nonso, for that question. So basically, like I mentioned, at the back of our minds, as I've stressed from the beginning, is the fact that these numbers, while the headline numbers are lower, but there's a discontinuity. So if you want to look at it from the fact that, oh, inflation headline is at this level, previous one was at that level, and you want to look at it and conflate the two of them, you may be arriving at misleading decisions on the basis of that. So for states or subnational governments, what I would say is that business as usual, in the sense that don't put so much weight on the fact that, okay, inflation has dropped. Don't read it from that perspective. That's what I mean by business as usual. Don't get me wrong. Don't put your thinking or your understanding or your decision making on the fact that, oh, inflation has dropped. If you look at it from that perspective, then you are going to lead to misleading policy decisions. So look at the reality on ground in terms of what the people in that state are going through in terms of their lived experience. Have prices sufficiently dropped? Has the lived experience improved? Has the inflationary pressure declined? Like we showed in the course of this presentation, month-on-month inflation printed at 10.68%, which is substantially high in any country. So that is a guidance to any subnational government in terms of how they should proceed, in terms of what policies that they make. It should be more of still ensuring that there are opportunities for their citizens or their residents to get good jobs, welfare, and all that in terms of whatever safety nets, social safety net that they have put in place. They should not just uh, start closing those sort of safety nets to ensure that the less privileged and those at the bottom of the pyramid are still able to have some level of life and they're able to survive and thrive and all that. Also ensure that they keep providing opportunities for skills acquisition and the rest. Thank you.
Thank you very much, Jude. I'll take two last questions before we call this session a wrap. So my next question is from an anonymous attendee. This person says, thank you for the insightful presentation. Looking ahead, what would be the key things to consider in forecasting inflation and areas to pay particular attention to? A key concern, for instance, for me, in terms of some of the new segments included in the basket, may be how to manage potential runaway inflation in segments that don't have strong price controls regulation-wise. Your guidance on the key things to consider in forecasting would be helpful.
Thank you,
Thank you.
for that question. So at this point in time, like the it's still early days. So forecasting as it is an uncertain science. So making any call right now obviously is going to lead to a lot of revisions at the end of the day. But like you mentioned, obviously you cannot live in limbo without having some level of guidance and say, okay, this is how we want to proceed. So what is the best call for us to make? Best call is that's where that back testing thing would be very useful. If CBN, or I mean the National Bureau of Statistics, can provide some level of backtesting to show us how these figures going back into the past will have evolved to arrive at this current level, that will give some level of guidance to help us also predict what could happen in the future. Beyond that, too, like I always say, there are a number of factors that are beyond just the immediate control of Nigeria. So factors beyond that are outside, that are external. So things that could happen in terms of global events that could have some level of impact on us as Nigerians are there. So we also need to be wary or be very conscious of those kinds of factors where you are trying to make predictions for the future. So right now, it's an uncertain science, but inflationary, what I would say, bottom line is that inflationary pressures have not diminished. And I would say, if I'm to stick my neck out over the course of the next couple of months, we're still going to see some level of, in terms of the headline figures, it's still going to be trending around current rates. It's not going to show a significant decline from this current, these January figures that we've seen. So, though it may obviously fluctuate or up and down before it arrives at whatever it gets to at the end of the year, but please, at the back of our minds, let's know that the month on month should be perhaps the litmus test for us right now. Thank you.
Thank you very much, Judy. I have my final question from an anonymous attendee. This person says, how should the private sector, including multinational corporations, SMEs, and banks, interpret and respond to Nigeria's rebased CPI when making long-term investments and lending decisions? The second question from the same person would be, what is Agusto Consulting's inflation outlook going forward? Do we expect a decline or an increase? What do you predict at the end of the year? What do you predict the end of the year is?
Thank you so much for that double pronged question. So, uh, how should organizations, corporates cope with, in light of, or how should they interpret these numbers, and what should be their appropriate responses to all these figures? So, what our advice is this: no person bases his cost or his pricing simply on a National Bureau of Statistics or Statistics Office figures at the end of the day. You base your costs and your inputs, your prices on your own input. So, has anything changed in terms of the input prices that you factor into your production? I'm sure nothing has changed, or nothing has changed significantly downward. So, in the light of that, then you should be very wary of doing anything to the contrary. So, ensure that yes, you still optimize your pricing. Like we mentioned, some of the factors I mentioned in the course of the presentation was that for some customers that are price sensitive, then ensure that you have some level of differential pricing to cater to those kind of customers, such that you don't lose them, because you need them too for your business to thrive. So have some level of differential pricing to cater for the price sensitive customers. For those that are, for equally to ensure that um, you can also use that shrinkflation approach. So for commodities, rather than totally just hike prices, we've seen companies begin to sort of minimize or reduce the quantity of those particular prices, of those commodities, while still maintaining prices. So a number of these factors, juggling them together, can help businesses, corporates, and others to thrive too. For banks, the reality on ground has not changed, like we all know. So the common man is still under the pressure. Is still finding it difficult to meet up with their obligations. So equally to no bank would, on their basis of merely rebase new inflation figures, take such a drastic decision to cut or reduce their lending rates or anything. It has to do with what is reality on ground and what is the policy rate saying. So those are the guidance that the banks and financial institutions will also be looking at to ensure that they make their decisions. They are not going to like rush on the basis of the fact that inflation figures that have come out for January have seemingly printed at a lower rate. So basically, that is for the first part of your question. For inflation projections for based from Agusto side, inflation is going to be something that is going to be under watch. Nobody's going to stick their neck out immediately right now in the course of following these particular numbers. One data point is not a trend, so you cannot generalize. And again, too, like I mentioned, there are so many factors that are outside the immediate control of the Nigerian of Nigeria that could have some level of impact. Let me give an example. Currently, we have a Trump 2.0 in the United States, and we know that Trump is somebody who is a big believer in fiscal spending. He has said he's going to cut taxes, he's going to spend a lot to boost the economy and all that. Why is all this important? He's going to drill, baby drill. That is going to go into a lot of oil exploration and pump a lot of oil into the market. And when that happens, what happens to us as Nigerians? There's going to be saturation of oil in the market. Prices may likely come down. Oil is our major revenue earner. When that happens, what happens to our firepower to maintain or support the naira? It diminishes. When that happens, what happens to exchange rate? It depreciates. When that happens, what happens to inflation rate? Imported inflation becomes a problem. So all these variables are so much in the air right now. So we live in a VUCA world: volatility, uncertainty, complexity, and ambiguity. Making such a call right now will be almost like what they call in Japanese terms harakiri, killing yourself, disemboweling yourself. You are most likely going to get it wrong, and you will come back tomorrow and be explaining, and like you say, you will explain tired. So right now, I don't want to put a figure on what our projections are for inflation, but just to say that we just strap in for the ride and see how it goes. After one or two data points, then we can say we have some level of handle on that. Thank you.
All right, thank you very much, Jude. Thank you all. We have come to the end of the Q&A segment. Thank you for your excellent questions and your engagement. And a special thank you to Jude Olugbo for sharing your expertise and providing such thoughtful responses. We will send the presentation slides to everyone who has registered, and the recording of the webinar will be uploaded on Agusto and Co's YouTube account. Please share with your friends and colleagues, and remember to like and subscribe while you do. At Agusto Consulting, we are committed to providing businesses and households with insights that they need to navigate Nigeria's complex economic environment. If you'd like to discuss how this rebased CPI impacts your organization, or explore some of our tailored solutions, such as macro sessions, such as macro sessions, scenario planning, strategy engagement, client-specific research, and training, please do not hesitate to contact us at info@agustoconsulting.com. We also have software tools like the credit risk management application that can help your credit risk evaluation, and the HR Click, which helps companies automate, reinvent their end-to-end human resource management. Our parent company, Agusto & Co., also provides Agusto Market Intelligence Risk Application, where you can access our risk reports and credit rating reports for various industries. In addition, we provide comprehensive industry reports that tailored to help businesses make informed decisions. Please reach out to us at info@agusto.com to access these reports and application. Thank you once again for joining us today. We hope you found the webinar valuable. We appreciate your participation and look forward to seeing you at our future event. Do have a wonderful day. Thank you very much.